Broadcast is now starting. All attendees are in listen-only mode.
Hey everybody, this is Charlie Dobbins coming to you live from Boston, Massachusetts. Wanted to give you an update on a couple of things regarding the goal coaching program. For some of us, we were at the Lexington, Kentucky due diligence seminar this weekend. That was a great time, and we really were able to dig down deep into what it takes to buy a property, understanding what it's going to take after you have got the property under contract. And the whole point of the weekend was to try to increase your competence, which would increase your confidence. And that way, when it comes time to start making offers on deals and really start to have the rubber meet the road, you'll find that it's not that tough. You just have to know how to do it. It's very simple. It's just like anything else. So today's gold coaching call is going to be about partnering. I've noticed that on the Facebook group, there are an awful lot of posts about people looking to get into partnerships. And I think that's great. I think that's fantastic. Most every deal that I've ever done has been the result of a partner. And it really can help you catapult your investment business and take it to the next level. But at the same time, I'm here to tell you that it's not all wine and roses. You've got to understand exactly what the pitfalls are, what the problems are, and how to solve those problems as it relates to partnering. Let me just start by going over what I would like to consider, the reasons why somebody partners. Why do you want to partner with somebody that you've just met on a Facebook group? Well, it probably is because you feel as though you're lacking some requirements necessary in order to get a deal done. You're lacking the talent. You're lacking the time necessary. You're lacking the skills, and you're lacking credit and money. Just keep in mind that every one of these particular criteria can all be quantified. And that's something that we're going to be talking about later on as we start to dig down deeper. You're going to need to quantify exactly what it is that each partner is going to bring to the table. I'll give you an example of some of the partnerships that I've been in. I mean, early on in our investment career, my wife and I purchased a couple of apartment complexes, and we were very successful with it. And a bunch of people kind of heard about the fact that we were able to make deals happen, and they contacted us and said, hey, we would like to partner with you. Now, the question is, what exactly, why would I partner with these people that just, I've met through different RIA clubs? And the answer is, when I was building my business, I realized how much time it took in order to get deals accomplished. If we could bring on additional people into a new partnership, that would really help us in order to get deals done. So for us to continue to grow at the pace that we were growing, we felt as though we needed to partner with people. So in this particular case, these people were going to bring time to the table. They were going to bring certain skills and certain talent. Now, when you think about it, what exactly are the talents that we need to have brought to the table as partners? Now, remember, we've already been successful. We've already been able to purchase multifamily property. So what other talents could people bring to the table? Now, obviously, what we're trying to do in this business is grow as big as we possibly can. Everybody wants to own 1,000 apartment units. Well, to do that, you need people behind the scenes. You need a real business infrastructure in order to do that. And what these people, these partners that contacted us, said they could do for us was to help build this business infrastructure that would be able to raise capital on a systematic basis. They would be able to manage the property for us. They really just came to the table saying that we can do all of these things. Let's just lay it out, and that way we can start to acquire more property in a much faster time. So that's some of the things that the partners said they could do. One other thing here has to do with credit. Now, credit for many people means, 760 credit score, FICO score, 600 FICO score. Now, what we're really talking about here in the multifamily world as far as credit goes is a sponsor. A sponsor is really the one that acts as that credit partner, somebody that has experience, somebody that has a strong balance sheet, someone that can show liquidity in their bank account equal to 12 months of mortgage payments. That's what we're referring to as a sponsor, or as a credit partner. That type of person can come into the partnership and be given the same type of role as someone that is working very hard on a day-to-day basis. That's something you need to keep into consideration. Keep in consideration as you're going through this process. Now, um, always there are always deficits in any business arrangement, and the proper partnership is going to fill those critical gaps. So when you sit down and you decide you want to think about taking on partners, you've got to really be honest with yourself and figure out what it is that you're lacking in your business skills that a partner is going to bring to the table. I think we even say it a little bit later on that this is a partnership and not a friendship. You don't want to do business. You don't want to have partners who have the same problems that you do. You want to find people that make the entire partnership as a holistic group very adequate. Make sure all the gaps are filled in the arrangement. And your business may need more than just you. I tell a story. My father was an incredibly successful insurance agent, but he was always a one-man show. Could he have got bigger if he brought more people into the mix? Absolutely, but that wasn't his style. So you've got to ask yourself, how well do you work with other people? Can you work in a partnership? Can you do all those things necessary in order to make a partnership successful? Or are you like a bull in a china shop where if somebody ruffles your feathers, you're just going to take it personally and you're going to blow up? I mean, these are things you really need to think about. Do a real deep perspective look on what your accomplishments are. Now, let's talk about the pitfalls of partnering. And this, folks, I can tell you right now, I am an expert. I like to call myself a self-proclaimed expert on the benefits to partnership, but at the same time, I'm also an expert at the pitfalls of partnering. So what you need to think about here is you've got to date the person before you marry. You've got to, as my mother used to say, you've got to see the person in all 4 seasons before you marry them. That's one of the biggest things that I see people making a mistake. They do not really know who the other partner is. They don't know exactly what they can bring to the table because they haven't done the vetting process as well. So one of the biggest issues we always see, and this comes up all the time, and everybody is guilty of this. I'm telling you, everyone is guilty of this. I was guilty of this. And it's what we call boot camp love. It's getting into the infatuation stage. You go through what we call an artificial environment when you get to these boot camps. What happens is they create this infatuation stage where you're in this setting for 3 days where everybody is being riled up and made to think that they're all going to make millions of dollars in the multifamily business, and then you start to line up everybody and say, hey, how about you partner with me? Great, let's do it. And that is probably the worst environment for people to get involved in these types of partnerships. So definitely when you come out of a boot camp, that's not the place. You can meet a lot of people there. You can find some great contacts, but it doesn't necessarily mean that when you walk out of that place, the guy that you just met, the guy that you just had lunch with, he's going to be your partner. He's the guy that you want to start building your multifamily business with. Like I said before, partnering with someone like yourself is a huge mistake. You want to have other people who fill in the gaps for you. If you're not good at paperwork, don't hire someone on as a partner who's not good at paperwork. If you're not good at reading financial statements, make sure your partner does know how to read a financial statement. If you're the backslapping fun guy who can get out there and raise private money, great. Don't make your partner be the same type of guy. Somebody has to stay back in the office and make sure the operations are running smoothly. So make sure that you don't hire somebody like yourself as a partner. And Just remember too, folks, this is a partnership and not a friendship. When your wives get together to have dinner, don't expect your wives to be best friends. It's just not going to happen that way. This is a partnership. This is a business arrangement. It's not a friendship. It's not your high school reunion. When you start to work with partners, treat them like business professionals. Don't treat them like the guy you're going to go out and play golf with every afternoon. Now, the other thing I wanted to touch upon here is, what about partnering with friends and family? That's always one that has been a problem, or not necessarily a problem, but something that you always have to take into consideration. Now, your brother may be the greatest guy in the world, and I'm telling you, my brother is the greatest guy in the world. And my brother and I could partner together. I know we could. We have very opposite things. I mean, he's nothing like I am, and we could partner together, and we would make a great team. But keep in mind, folks, that when you put together a partnership like that, what you need to protect yourself against isn't so much something going wrong with your brother or another family member. The thing that you need to protect yourself against is something going wrong with the in-laws, so to speak. And here's what I mean. Keep great records on everything. Keep very good records on your email, phone calls, phone conversations. Make sure you document everything. Even though it's your brother, make sure that there is a proper partnership agreement. Make sure that there's a proper offering memorandum. Make sure there's a proper private placement memorandum if you're going out to raise private money. You want to make sure that you've done everything correctly, everything legally. And here's why. The problem, if something goes wrong, is not going to be with your brother. The problem is going to be with your brother's widow's next husband. Your brother passes away, and now you're partners with your sister-in-law. And then she goes out and gets married, and she marries this guy who is an absolute bum. And he finds out that, hey, there's this partnership that owns a multifamily property. I want mine. And if he finds out that the partnership was not set up correctly, he's going to go blow that partnership up, and you might end up losing everything. Make sure you keep excellent records on everything. So let's talk about, and this is something that we've seen happen quite a bit. Oh, sorry about that, folks. I apologize. I left my my Skype open. So, tell you what. Let me just make sure that I'm going to go close my Skype. Just 1 second. All right. And we are. All right, and we are back. Okay. Now, here's one of the issues that we had when we were setting up one of our partnerships. We had 5 people looking to get into this partnership, okay? Each person thought that they were bringing a different talent to the partnership. So everybody thought, like, well, if I'm doing this job and you're doing that job and and the other guy's doing this job, all of us are bringing unique talents to the table. What's happening in this case is everybody should get 20% of the partnership group that we've created. Okay, let's assume that that's correct. But what we need to do is, before we start giving out 20% to everybody, let's start thinking about exactly what it is that people need to do in order to make this partnership successful. So let's look at all the aspects of acquiring multifamily property. First one is, you got to find the deal. So somebody has to spend the time to be building up the broker relationships, to be getting out there, knocking on doors, to getting quotes in the door. Once the quotes come in the door, I call them quotes. Once the property packages come in the door, you've got to be able to analyze it. Somebody in that 5-person partnership has to analyze that deal. Once they've analyzed that deal, they've determined whether it's a deal or not, they're going to make offers on it. And then through the offer process, the deal is going to come under contract. Once a deal comes under contract, then somebody in the partnership is going to have to get out there and do the due diligence. They're going to have to take their expertise and be able to go through every single unit and look at all the leases and really put together a strong due diligence package. And then while that's going on, somebody has to be speaking with the broker, the mortgage broker, to figure out exactly what the property is going to need to do in order to qualify for financing. And then they've got to go through that entire process, the financing process. While all of that is happening, once the due diligence is determined that this property is going to go ahead, then somebody's has to get out there and raise the private money for the down payment and the closing costs. So somebody else has to start doing that process as well. After that's all done, you're going to close on the property, and then here's what happens next. And this is where everybody seems to gloss over. Once the baby is born, somebody has to get up and nurse that baby for the next 5 to 7 years, every single day. And I don't want you to make the misunderstanding that, oh, well, wait a minute, Charlie. No, that doesn't have to happen that way. We're going to hire a third-party manager, and that third-party manager is the one who's going to be involved in this process every single day. Okay, fine. Let's say that that's how you've decided you're going to set up your partnership. Someone still needs to run the company that oversees the property. Someone still needs to make sure that they're there every February in order to get all the tax records together to the accountant, get the K-1s out to all the investors. If there are any questions involved throughout the course of the year from the third-party manager, there has to be somebody involved in making sure that gets taken care of. I mean, I'm telling you, folks, it doesn't end after you acquire the property. That's just the beginning. So when you're looking at these partners, you're talking to these partners, and everybody thinks, oh, I can do this, and I can find the money, and I can analyze the deals and get them under contract. All of those things are finished in the first 90 days of ownership. In the first 90 days of the process, all of those tasks are taken care of, and they're done. Who is the partner that's going to continue to run that shop for the next 5 to 7 years? And that's one of the problems that we had when we were first setting up this 5-person partnership. Everybody had a task. And what we realized when it was all said and done, and this is going to maybe come as a surprise to many of you, you know how one person is really good about raising money? And so you're going to, oh man, this is fantastic. This partner can come on board and they can help us raise money because they're really good. They've got a lot of contacts, all this other stuff. I'm telling you right now, folks, when the deal got done, when the money was raised, and then the property still needed to be run, the thing is that property, the person who raised the money, had nothing left to do. They still owned 20% of the partnership, just like everyone else, but their tasks were done. And they just sat back and rode the coattails. It took their 20% equity was earned in the first 60 days. And for the next 7 years, they got the same amount of equity and membership interest as the other partners in the deal, some of them who were working on a daily basis. That created a lot of problems among the partnership. But those are the types of things that you've got to get on the table early on in the discussion. How do you pay partners? How do you pay partners? You've got to this is one of the toughest discussions that you will ever have. Let's say you meet somebody at one of those boot camps, and this guy is just right. He fills in all the gaps, and this is the guy that you're going to want to start building a multifamily business with. When you sit down, you've got to have this discussion about how does everyone get paid in the partnership. It is the most uncomfortable conversation, but it is one that absolutely has to happen. You've got to have the uncomfortable conversations now before there's a problem. Otherwise, later on when there is a problem, it's going to get ugly. So make sure you take the time and you act like the grown-ups and you have these conversations first. Should everyone get an equal cut? Is that really the way you want to set up your partnership? So that before anything else happens, before the property is even acquired, and you know who is going to be there at the end of the day running this property, are you going to give everybody the same amount of ownership interest in that property? Should your partnership interests vest over time? I think this is a great one. And let me tell you what happened in one of the deals that we were involved in. The two of the partners got their membership interest handed to them at the closing table, and they were done. We never saw them again. What happened was the property started to run on tough times. It required some cash calls in order to keep it going. So we would go back to the membership parties and say, hey, we need more cash. And they would say, what are you going to give us for it? You're not going to keep coming at us looking for more capital. We want something for this. And so what ended up happening was the cash members came back and said, you know those two partners that got their membership interest at the closing table and we've never seen anything more of them? We put our money into this property, into this deal, because we thought they were going to be involved in this operation on a daily basis, and they weren't. And we don't think it's right that you keep coming back to us looking for capital, and these folks haven't done a thing. If you want us to put up more money, we want their membership interest back. And it got very, very tough going there for a little while. Ultimately, those two members came back and gave back their membership interest to the LLC. So you've got to ask yourself the question, at the closing table, should everyone's membership interest vest, or should the partners actually earn their membership interest over time as they continue to work within the business? That's something you need to discuss with these partners. Should one partner get more than another? And should how can you separate the buckets of money? Here's what I mean. Should one partner get more than the others? Well, if he's bringing more to the table, remember those 5 elements we talked about before: credit, money, time, talent, those types of things. If somebody is bringing more to the table, why should everybody be equal? This is a meritocracy. This is not a democracy. If somebody brings more to the table, that person should be able to get more. Now, how can you separate the buckets of money? This is something that we're going to talk about a little bit more in how you set up the partnership arrangement with the limited liability company. I'm going to assume through the course of this discussion that we're going to be talking about limited liability companies as the entities that run these partnerships. How can you separate the buckets of money? What are the buckets of money? Well, think about it. When you're talking about owning a multifamily property, you've got a couple of different places where there are buckets of money. You've got cash flow and you've got equity. You got cash flow that comes in on a regular basis into the membership, provided that the membership is the property is being profitable. And then on top of that, you've got equity distribution. So at the end of the day, when you go to sell the property, the equity will hopefully have gone up in the deal, and there'll be a big chunk of change to be divvied out when the property gets sold. These two elements, the cash flow and the equity, can be separated and put into different buckets. You can pay your partners out of one bucket versus the other, and you can actually give your investors a preferred return on the ownership structure, so that, let's say, they get a 9% return before anybody else gets a cut of the pie, and that protects the cash investors. But then you can always separate out exactly how these partners get paid. So think about that. Get creative when you're trying to figure out how exactly can we as partners get paid in the arrangement. I speak to my clients, my investors, all the time about exactly how to structure these types of deals. And a lot of it even has to do with when you're buying the property, if the seller is looking to do some type of creative financing on the deal, you might even think about creating a bucket, even a third bucket in the operating agreement that gives the seller a share in the LLC. And we do that quite a bit as well. Now, should a partner be paid a salary for his work? Absolutely. If that partner is involved in the day-to-day operations of the property, just like a third-party manager is, there should be absolutely no reason why that partner cannot be paid on his deal, on his time. And if you look in most operating agreements, it clearly states that members can be paid by the investment for work that is done. So make sure that that type of wording is in all of your operating agreements, and understand that that is not a prohibition on any members. They can make an income. Now remember, what I'm talking about is an income. That is not a distribution. That is not an equity distribution. This is like paying them a third-party management fee. You can do that as well. Now, let's talk about how you're going to set up your partnership legally. Think about the different type of entities that are going to be involved in the transaction. Okay. Now, for the sake of this discussion, okay, I have a question here about how membership's interests vest over time. Okay. You know how you have your 401k and you have your employer contribution into your 401k, and your employer is going to match your contributions by, I don't know, 20% or what have you. But that takes 5 years to vest. So if they put in $1 today, you're going to actually only own 20 cents of that dollar in the year one, 40 cents of that dollar year two, 60, 80. And so by the end of 5 years, you will have now vested and you now own 100% of that dollar that your employer contributed 5 years ago. So that is what we mean by vesting. And in the partnership arrangement, what we're talking about is that, hey, you're entitled to 20% membership interest in this partnership, but you're not going to get all 20% at the closing table. You're only going to get 4%. And every year thereafter, the partnership is going to give you another 4%. So that by the end of 5 years, if you're still around, if you've done all of these particular things, we will make sure that you will have then earned your 20% membership interest in the partnership. Your interest will have vested. And the reason why you do that is you're dangling that carrot in front of that person so that they remain involved in the deal. Because if you give the partner all of his membership interest on day one, he doesn't have to do anything else on day 2 through year 10. He got his money and he's done. So having a membership interest vest over time is something that really protects the partnership and makes sure that nobody is going to start, that everybody's going to be doing the work that they need to be doing in order for the partnership to be successful. So let's take a look at how to set up a partnership legally. Think about the different entities that are going to be involved in the transaction. Okay. One entity, and I'm going to have this whole entire discussion, and it's all about limited liability companies. I'm not going to talk about S Corps, C Corps. I'm not going to talk about actual partnerships. Excuse me, folks. I am going to talk about limited liability companies. All of my entities are owned in the limited liability company. I think they're relatively new entity structure. They are great. They are easy to create. They are easy to design, and they can work in millions of different ways. So using a limited liability company is the easiest one. And for the sake of this conversation, all of these discussions will be based upon the entity being a limited liability company. So what do we do? First thing you're going to do is when you make the offer to purchase the property, you're going to say, Charles Dobbins and or Assigns is going to buy this property. And then when you move to the purchase and sale contract phase, you're going to say, Charles Dobbins and or Assigns. And then once it looks as though you're going to buy the property, 5 days before the entity is acquired, before the asset is acquired, you're going to go out there and create a new entity. And let's say it's called ABC Investments, LLC. So in other words, Charles Dobbins has just assigned the contract to this new entity called ABC Real Estate, LLC. ABC Company LLC. That is the entity that owns the property. Okay? Now, in addition to that, Charles Dobbins and his partner, let's say his partner David Kiles, says, okay, we're going to set up our own little partnership here, and we're going to call it Los Angeles LLC. And I am going to own 50% of Los Angeles LLC, and David is going to own 50% of Los Angeles LLC. And what we have determined, based upon the numbers on the deal, is that we are going to keep 25% ownership in ABC Company LLC. We're going to sell off the other 75% to our investors, and we are going to keep the other 25%. So now we've got two entities. We've got the ABC Company LLC that owns the property, and then we've got, actually, let's call it XYZ Company, because I think that's what I called it in my design here. We've got XYZ Company that owns 25%. Now, XYZ Company is what we call the sponsor. XYZ Company is the company that's gone out and created this deal. It's put this deal together. And to do that, we have just paid ourselves 25% of the membership interest. Now, the question then becomes, how should our membership interest be held? So David lives in LA, and he's got a wife and some children, and I live here in Boston, and I've got a wife and kids, and the two of us together have created this company called XYZ Company LLC. Now, let's say David and I don't like each other after the end of this deal, and we decide, that's it, we're done, we're never doing another deal again. Well, David and I, along with all of our family and friends, family and kids, are married together because we both own this XYZ Company LLC. He owns 50% and I own 50%. And we can never get out of this deal until the property is sold. And that is the problem when you structure the partnership entity, the sponsorship entity, as being owned together by both of you. All right, so how do you solve that problem? Here, actually, I think I just mapped it out here. ABC Company owns the property. XYZ Company is a sponsor of the deal and will end up owning 25% of the membership interest in ABC Company. Partner A and Partner B, David and me, own 50% in XYZ in the name of their individual real estate holding companies. David holds it as his company. I hold it as Dobbins Company, LLC. Now, what happens when the membership interest in ABC that XYZ owns when XYZ divorce? So David and I are getting divorced. So what happens in this particular case, as I just described, we're stuck together. But let's think about it for a second here. How can we solve the problem so that David and I are not stuck together? So that at the end of every deal, he and I can separate on good terms, and he goes off and does his thing and I go off and do my thing. And the answer is we end up not owning our membership interest, our sponsorship interest, in the name of XYZ Company LLC. What we end up doing is David takes 12.5% of the membership interest of ABC Company in his name, and then I take 12.5% of the membership interest of the property in my name. And that way David and I are the managing members of this entity, the property. He and I still run this property every day. But if David ends up needing money 5 years down the road, he can take his 12.5% membership interest and sell it to somebody else. And provided he complies with the operating agreement for transfer of membership interest, he can do that. Now, if he and I own the property together, own that sponsorship, the membership interest together in the form of XYZ Company LLC, I can tell Dave to go pound sand and say, Dave, no, you're not allowed to sell your 50% interest in the company. You're tough, tough luck. If you want cash, I'll give you cash, but it's going to cost you a lot more money. So David is now beholden to me as a partner because we set up the entity this way at the very beginning. So my advice to you folks is, the beautiful thing about real estate partnerships is that they only have to be one deal long. And you want to make sure that you structure the ownership arrangements so that you can get out of them and not have to ask anyone's permission to get out of them, like a disgruntled ex-partner. And you want to be protected so that if anything happens to you, your family's going to be taken care of. So that is, I hope I explained that well. If I didn't, if anybody has any questions about it, please just type into the question box. I'll be more than happy to answer it for you. So let's talk about how you're going to set up your partnership legally. Obviously, as we said before, if you're setting it up as an entity, I see David Kyle says he and I will never, either David says that would never happen. I don't know if David meant that what would never happen is he and I would be partners, or that we would break up. Anyway, if you're looking to set up a limited liability company, the first and legal document that you're going to create is what's called an operating agreement. Okay. Now, there are typically two types of operating agreement. You're going to have one that is geared towards property ownership, and then you're going to have one that's geared towards business ownership. And what I mean by that is, if you look at a standard operating agreement that we use for all of our properties, it discusses property, and it's very property specific as to what happens if something should happen within the ownership of the property. A limited liability company operating agreement for a business that is not real estate specific is written differently. So for instance, in the case with David and myself, he and I would have an operating agreement that's business specific, one that talks about him and me as partners, and then there's going to be another operating agreement that talks about ABC Company LLC that owns the real estate. So that's the first document that you're going to need on a limited liability company, is the operating agreement. Next thing you're going to need to determine is whether it's a manager-controlled LLC or whether it's a member-controlled LLC. Now, this one gets kind of confusing because a lot of times there aren't very many people involved in the membership, so it's almost like everybody is one and the same. Here's how it works. If you're a member-controlled LLC, the members vote on who the manager is, and by a majority rule, you determine who is going to be the manager that runs that property. If the members decide they don't like that manager, they just vote him out and vote in a new manager. On a manager-controlled LLC, that's where the manager dictates as to how the property is going to be run, and usually the way that you get rid of a manager in a manager-controlled LLC is very, very challenging. It usually means that there's fraud involved, that there is some problem with the running of the property. It's awfully hard to get rid of a manager in a manager-controlled LLC, and that's by design. If you folks are looking to be the sponsors on a multifamily property, you want to write the operating agreement in such a way that you are the managers and nobody can kick you out. So keep that in mind when you're looking to put together an operating agreement for an LLC. You want to always remain in control of the deal. Now, I can tell you, I come across this all the time. Clients come to me and say, hey, listen, I put some money into this particular deal, and now I don't like the way the manager is running the property. What can I do? And you look at the operating agreement, because that governs everything. If you go to court, the court is going to look at what the operating agreement says. And if it clearly states the manager is in control, you're out of luck. So if you're looking to invest in a limited liability company for multifamily, understand that if you don't like the way the property is being run and it's a manager-controlled LLC, chances are going to be very good that you're not going to be able to get rid of that person that you put your money into. Make sure you don't fall into that trap. So I see that more often than you can imagine. Now, the sponsoring partner should be the manager, and as I said before, never, never, never give up that right. Now, here is something that is very, very key, and people gloss over this when they're reading operating agreements. Understand the difference between unanimous consent and majority consent. This is key. If making any changes requires unanimous consent, chances are very good you will never be able to make any changes. Because let's say, for instance, in the case of David and myself, he and I are running this property and the members don't like us. And in order to get rid of us, they need unanimous consent. Well, guess who owns 25% of the deal and is not giving it up? David and myself. He and I will never give unanimous consent to vote us out as managers. So if it says in the document that to make a change requires unanimous consent, that is the equivalent of never being able to get consent whatsoever. Majority consent is just what it sounds like, 51%. If you can get 51% of the membership interest to agree with you, you can modify the terms of the operating agreement. So keep that in mind when you're talking about these things. And the beautiful thing about limited liability companies is that you can devise different classes of ownership. You can have the preferred members. Those are the people that get a 9% preferred stake in the distributions. You can have the sweat equity class, and those are the people that earn their membership interest because they don't bring any cash to the table, but they get it by doing certain tasks. I mean, I've set up limited liability companies where instead of doing a second mortgage, what we end up doing is we create a class of ownership for the seller so that the seller can get that ownership back to him, very similar to a second mortgage, but it isn't secured by the property, which would put it in violation of the Fannie Mae guidelines. So there are so many different ways that you can structure a partnership and structure the operating agreement on a partnership. That's what I really like about limited liability companies. So what are the next steps when it comes to setting up a partnership? Folks, fools rush in where wise men fear to go. All right? That means don't come out of these boot camps and think, oh, I met this guy. He's great. Let's set up a partnership. Take your time. Don't think that you just met the guy who's going to be your, it's like the two of you are like Rogers and Hammerstein. It just doesn't work that way. Take your time. As my mother said, date many people before you get married. And also be incredibly frank in your discussions. It is so much easier to tick off a person across a restaurant table before you own a multifamily property than it is when you can tick them off across a conference room in a law firm because the two of you are now divorcing. Just always make sure that you've had these tough conversations. And I'll ask the question when a client comes to me and says, hey, I'm having partnership problems. Well, tell me about how you guys met. And it goes right into like, oh, we met at a RIA club, and he seemed like a really nice guy. All right, well, what did he have to bring to the table? Well, he said that he's done this before, and he was very familiar with multifamily. And did you find that out to be the case? Well, no, it turns out that he had never done this before, but he had been to a couple of boot camps where he was learning how to do it. Okay. That's the first red flag. I mean, I was in a partnership for an insurance business that I was in, where I found out early on that my partner had been lying to me the whole time. I can tell you, folks, that is from that point on, and we were already in the partnership. From that point on, I had suspicions about this guy every step of the way. So you want to make sure you get these conversations out on the table early, and don't be afraid to try out a whole bunch of possible suitors, because you never know which one is going to be the one that is the right one. And remember, real estate partnerships only have to be one deal long. If it doesn't work out, move on to the next guy. Do the deal and then move on to the next guy. So that's part of the problems that that I see with actually, here we go. I forgot to take that out. So those are some of the problems that I see with partnerships. I see a lot of new investors just thinking, oh, I'm just going to do this and everything's going to be great. And you know what, folks? It can be absolutely fantastic, but you've got to go into it with your eyes wide open. So if anybody has any questions, you can always contact me at charles@dobbensco, DOBENSCO.com. And I always ask that you type the subject line in all caps so I make sure that I know that it's coming from a gold coaching student. But definitely, if you have any questions, let me know. And also,